Amortization is paying off debt over time in equal installments. Part of each payment goes towards the loan principal and part goes towards interest. As the loan amortizes or as the loan goes on, the amount going towards principal starts out small and gradually grows larger month by month. So what does this look like? Let's say you bought a home for $300,000. I'm going to show you what this looks like on an actual schedule. Now, any home that you look at, you'll be able to just go to Google and you can punch in amortization schedule and you'll be able to punch this in and get the same numbers. This is what an amortization schedule looks like. So you can see here the principal and interest based on 300,000. Your loan balance starts at 294,000. Principal and interest payment without your tax and insurance starts out at $2,042. 253 is only going towards your principal that first month. You can see how it grows every single month, and your interest will go down every single month as well as time goes on. Now, you might be saying, Pete, I don't think this is a great deal. And the reason why is because, look, I'm only paying down my principal, $250, and I'm paying interest of $1,650 when I start. It makes sense. I understand what you're saying. If you rent, this is why they say buying is better than renting, because renting, 100% of the payment is going towards interest. There is no principal when you rent. And so when you start out, you have to start somewhere. And so you're starting out buying this home. Over time, remember, home's going to appreciate. And we talked about that in the previous video of leverage. Well, there's three things that are going to happen. I wouldn't count on having this mortgage for 30 years. You see, this loan, now we're in September 2023, we're at, let's say, 6.75%. When you buy this house, there is a great opportunity where rates could come down and you could refinance. Let's say rates go to 5%. Well, that's going to drop that payment from $2,000 maybe to $1,500, $1,600 per month. Well, then you can take that extra savings and start applying that towards a principal, or you could save it. So that's one thing that could happen. So you may not have this mortgage for longer than 4 or 5 years. The other thing that could happen is you could sell this house. And so you wouldn't actually have this loan for the full 30-year term. Or this is what I would do. Yes, you can refinance, but I would turn this into a rental when it's time for you to buy your next home. Turn this home into a rental and look what happens. This renter is now paying your principal down and they're paying all of the interest and paying down this principal, and you're getting the market appreciation. This is how you can build wealth with real estate. So you buy this first home, and because of amortization, when you turn this home into a rental, this renter pays your principal, pays the interest, and this home's going to appreciate over time. It's an amazing thing. It's great. This is amortization.